Hello, everybody, and welcome back to the Mouthy Money podcast. I am joined today by my brilliant co-host, Chris Chu, who is Head of Consumer Finance at Media Relations Consultancy, MRM. Chris, hello, good morning.
Good morning, Ed. How you doing? You all right?
Yes, I'm good. I have got up today and started my day with a very specific bee in my bonnet, which I'm very grateful that you have decided to come down this rabbit hole with me today.
I love going down rabbit holes with you. It's fine. We always end up somewhere interesting.
I know exactly. So today I'm going to be talking Chris through a perhaps forgotten process, something that was a tool used historically by governments to do specific things, which we're going to talk about. And that concept is something called financial repression. Now, it sounds pretty extreme. It
Yeah, it
sounds
sounds
like
brutal. Use the word repression. I'm concerned.
conjures images of bank managers beating their customers and things like that, but it's not quite that bad. But it is a specific concept that I want to bring to the attention of the Mouthy Money audience, because today the government has announced a sweeping set of reforms to pensions. So what are those reforms? What the government has effectively announced is it is going to essentially create pension mega funds with large amounts of capital in them. It says it wants to do this because it's going to make it more efficient. It's going to improve the purchasing power and negotiating power of those funds and all this other good stuff.
So how are they going to create those mega funds? Sorry, Ed, to cut across, but
So they're going to do things like combining. There's lots and lots of pension funds out there, and particularly with regards to things like local government pension funds, which I think hold nearly £400 billion worth of assets inside them. So they want to start basically consolidating all these funds into massive mega funds. That, the idea behind that is when you have big funds like that, they're able to be basically used and directed into doing specific things with certain outcomes that are kind of more beneficial for the country, more beneficial for the government. Anyway, that is the theory behind it.
okay.
Now, the government says this is going to be really good for savers. It's going to improve returns and this kind of thing. But what's the best way of putting it? The subtext here is, and this is perhaps the most controversial part of the announcements today, is the government is going to create a legal backstop for itself in order to, if pension funds don't invest more of investors, savers, pensioners, whatever you want to call it, if they don't invest more of their capital, their money into British assets, so UK investments, they are going to have a legal backstop, to force those pension funds to put more of that money into UK assets. It's not kind of specific on what those assets might be, but the implications is things like infrastructure projects, and potentially things like government debt as well. We don't have detail on that yet.
So to fund the things that we've argued on this podcast that we need.
Correct. Yeah. So this is not necessarily a bad thing, but this is where I'm going to just talk through the concept of financial repression and why this matters as a relevant part of the discussion, which I don't think most people are either aware of, and I don't think that much of the media is paying enough attention to, purely because it is just something that's kind of been forgotten, because it's something that happened in the UK quite a long time ago. But I think in the context of where we were then, and I'm going to talk through this, where we were then and where we are today, there's a lot of kind of similarities to that. So let me explain what financial repression is. So financial repression is a policy or a series of policies enacted by the government that results in savers, so that could be pension holders, investors, anybody who has capital, has money, earning returns below the rate of inflation. So what that means is when you hold your investments and it's basically growing by less than inflation, those investments are devaluing. And that's a bad thing. That is effectively the opposite of what you want to do with an investment, because
We're losing money basically because inflation's running too hot and things are getting more expensive and our money isn't keeping up.
Exactly. Now, what financial repression is it forces this on savers. It forces savers to earn below that level of inflation, and it acts as a form of stealth tax, basically. Now, there's a few different ways that governments can do this, and there's historic examples of this, but there's kind of 5 key ways, and I'll highlight the one that I think that we're looking at now. So there's five different ways to do it. So you can do explicit or indirect capping of interest rates. So basically forcing the Bank of England to cap its rate of interest. Don't think we're going to get that. I think that would be politically horrendous. It would be a disaster. So you can create government control or ownership of domestic banks. That's something that we had after the financial crisis, in fact.
Yes, RBS and all that.
Yeah. Yeah. Because then you can tell the banks to provide low rates of interest. Again, I don't think we're going back to that. NatWest are being sold off. It's probably not going to happen. You create basically high reserve requirements on financial institutions. So basically tell them you need to hold lots and lots of government debt, basically. Again, not sure we're about to see that, although that might come in the future. The next one is you basically create or maintain a captive domestic market for government debt. So you force domestic savers to hold, local debt, basically local government bonds. And that is where we are now. This is what the government is effectively proposing. Now, the last one is you could have government restrictions on the transfer of assets abroad. So that means money can't flee overseas. Again, we haven't had that explicitly, but that is something that has been discussed with things like the Brit ISA in the past. We've also had a discussion about, having a portion of ISAs compelled to be invested in UK investments. We're not quite at that point yet, but the point is that we are now at the point where the government is openly talking about the idea of forcing pension funds to hold British investments. So what do these do? These measures let governments issue debt at lower rates because effectively they're artificially suppressing rates for the domestic market. That means that it reduces their debt servicing costs, a big problem for the government at the moment. Huge amounts of money being spent on servicing debt. And then the negative real interest rate, so that's when the interest you're earning on a savings or an investment is lower than the rate of inflation. It acts as a form of taxation because you are deliberately devaluing somebody's savings. Now, there's historic context to this, which I think is really important because I think it helps reflect the similarity of where we are today. And Chris, as you know, I'm a historian and I love to talk about history.
Yes, indeed.
So the last time we really genuinely had financial repression was immediately after the Second World War. Britain had debt as a percentage of GDP of over 200%. I couldn't find the specific figure, but it was massive. Much, much bigger than where we are today, in fact.
Expensive to fund a war, right? Of that
Correct.
scale. Yeah.
So the government has a problem at the point where the war ends, where it says, we have to service these debts. It's a nightmare. We can't afford it. We'd have to massively cut budgets and that kind of thing, or raise taxes to do that. Neither of which you want to do, because if you cut spending, that harms economic growth. If you raise taxes, it harms economic growth. We're already seeing some of the impact of that at the moment now. So what do? You start using financial repression. Now, the UK successfully used financial repression to nearly halve its debt as a percentage of GDP over a course of about 10 years after the Second World War. The United States did it as well. By the 1970s, debt to GDP ratios were down to like 20-30% of GDP. So it was a very, very successful policy. From the late 70s onwards, all of these controls, and I think it was in the early 70s, these controls were removed. And the first thing we saw immediately as those were removed, pension funds were sent all of their investments abroad. Because investments abroad were better value for money for their savers, their members, than it was doing it locally. So what we are potentially seeing the start of today is the reversal of that decision in the 70s to release capital controls and end the era of financial repression. The reason why this works is because it functions like a stealth tax. So you are not raising someone's income tax. You are not taxing somebody's pension directly or cutting relief or anything like that. You are simply inflating away the value of the debt that they hold. And it is simple as that. And I think that we are now at the point where the government has decided this is the only thing we can do in order to not basically end up in a massive, massive fiscal crisis, because they can't borrow more, they can't tax more. The economy, it's going to kill the economy either way. So what do? You punish the people holding the debt. And you have to do that by forcing local people, the domestic market, to hold the debt, because foreigners will simply just sell the assets out.
Whereas if you force UK savers to hold it, then they're not in the position to be able to do that.
You have got a captive market. You can create laws that force people to do it. And that is today is the first step of really seeing that emerge now. So yeah,
So what
So
does that mean for me and you then, Ed? What does that mean for my Hargreaves Lansdowne SIP? What does that mean for my workplace
so
pension?
there's a really important distinction to make here. So financial repression gets called kind of a form of stealth tax because it rewards debtors and punishes savers. It especially punishes retirees because they are the ones who are most likely to hold government debt because it is seen as the most stable, less risky. It's more about earning an income because you get yield on a yield. You get an interest rate on a government debt. But what happens is it no longer generates the return you expected. You get below inflation returns, and effectively, it's giving you a haircut on the value of your assets.
So it's going to affect standard of living for retirees.
Correct.
If what we say is correct. It's going to reduce their
Yeah.
standard of living.
So this won't affect young people. It won't affect people who are working, who are earning income. I will caveat that because inflation will stay higher than it should be because the Bank of England is lowering its interest rates. What will happen is if you are not getting pay rises that match or beat inflation, you are also falling victim to the process. But the main target of this is people who are retired, people who hold government debt, people who will see the value of those investments lose ground to inflation. It remains to be seen what the government actually enacts here. And how much control people are going to have over their personal SIPs. I mean, at the moment, it looks like if you have a SIP, you probably still are able to just invest independently. But the point is, this is going to affect big pension funds where people don't have decision-making power over what their fund is going into. So that's going to affect things like final salary pensions more. It's going to affect people who are in government, like local government schemes where you don't have as much control over what's being invested in, kind of thing. So people who have, their own SIP and that kind of stuff, or maybe things like annuities, potentially going to be more protected from this. At the moment, it looks like, it's going to be the people who end up in those massive pension funds who could be. And again, we're yet to see this play out. But for me, this looks like the path that we are now traveling towards. And whether or not that's a good or a bad thing, look, the country's in a really bad place. But it does seem to be, for me, the answer the government is now reaching for because it has no other answer. It has no other tools left in its toolbox to fix what are pretty fundamental problems.
It's interesting. Just going back to, so you mentioned the SIPs might remain untouched, annuities, again, depending on, how you're heading towards your retirement or what tools you're using in your retirement. Things like our workplace pension, though, that's more likely to be sucked into these mega funds, right? Is that fair to say?
That is potentially true. And there are I think there's about 17 different pension providers who have agreed to the Mansion House Accord, which is a part of this, but doesn't go as far as what the government now wants. That being said, some workplace pensions allow more choices than others. And there's no indication yet that the government's going to start making those choices, start preventing people from having those choices. So for instance, I have a Legal and General workplace pension. Actually, we probably got the same one because we have the same company.
We do.
And there's a reasonable amount of selection of funds within that. And I know personally I've picked some of my own funds because I didn't want to be in what's called the default fund. But most people tend to be in their workplace pensions tend to be in the default fund. So what that default fund is then invested in, that matters. And that's potentially where people could be impacted. That being said, the younger you are, the less likely you are to be invested in government bonds because government bonds are really a tool that older savers will use because it's more about protecting either an income level or protecting the value of a pot. Whereas
so they've already built up a large fund, right? And they want to make
Exactly.
sure there's no massive swings that reduce that materially, but keeps growing enough to keep them sustained in retirement. That's right, yeah.
Absolutely, yeah. And but this is what the government is now targeting. It's saying this is going to act as a form of devaluation of that pot that you're never going to notice, other than the fact that your cost of living gets higher, but your basically your pension pot is not keeping up in retirement, and your pension income is not going to be keeping up properly in retirement as a result. Now, I will stress at this point that we are at the first step of this journey. We aren't at the point where the government's forcing everybody into, government debt and that kind of thing immediately. There are a lot of tools that they could potentially reach for, a lot of changes that could be made. But I think there is already a massive amount of capital out there, money in savers and investors' money out there that the government basically now has its sights set on. And I think we are, yeah, we're at a kind of the first step on that potential journey. My slightly controversial view here now, which I'm just going to finish on a bit of spice for you, Chris, because I know you love a bit of spice.
I do, yeah.
Is as much as I am giving this chat in terms of a warning, I actually think that it's probably the right thing to do.
Go on.
We've had this conversation before about things like state pension and how it's a massive cost for the government and things like that. And budgets are very difficult. We've seen the government roll back its plans to take away winter fuel allowance and that kind of thing. It's very, very hard to enact policies on retirees and older people when they are the ones who are essentially keeping you in office. And we saw the reaction at the local elections May as to how voters feel about things that Labour are doing, and they're not happy. So the only way to fix the problem that we have today, which is that government debt is too high, government spending is unsustainable, government taxation levels are unsustainable, is to basically tax pensioners in a way that they won't notice. And that is what financial repression is. They will notice it, but they will blame the cost of living. They won't blame the government.
I see. Yeah, I mean, let's think then about this. So we talked about sort of the negatives of it, I suppose. Well, what are the positives? These mega funds will be able to operate on a larger scale, create economies of scale, and therefore should be able to target some of the big fundamental blockers to the UK's growth, right? Like house building and all that kind of good stuff.
So the potential positives is that the economy can get more investment, more money will stay onshore and be used to do things like build bridges and reservoirs, which, I love talking about a reservoir. And we had an announcement today that they're going to build 2, they're going to push 2 through, which is pretty exciting.
Next to your house or?
No, far away. That's great. So we will get more investment in infrastructure and this kind of stuff. But the point there is investing in a reservoir in England might get you a return of, 5% or something like that. But the argument in favor of a free market is that building a reservoir in Peru or, somewhere else in the world entirely, be it in Asia or Europe or Africa, could get you a return of 10%. So you are forcing an investor to accept an inferior return in order that the government and the country can achieve some of its objectives in terms of capital investment and infrastructure and that kind of thing. So again, that is also a form of financial repression because you are forcing investors to accept lower returns where they could be earning higher returns elsewhere. If the effect of that is perhaps less clear because you're investing in things that aren't government debt, so they do earn, it's much harder for inflation to be higher than those kind of returns, generally speaking. Really, the financial repression is about government debt rather than the other side of it. So, yeah, there is positive in that sense that we could see more of that. But then the kind of counter argument, the proper free marketeer argument against that would be, well, if UK investments are so unattractive, you need to do things that make them more attractive. You need to cut regulation. You need to, give more protections to the investors who are looking to make a return, that kind of stuff. So there's 2 ways, there's 2 directions of travel in that street, and we've had big discussions about post-Brexit, the UK being very unloved. It's unloved because, investors are concerned about political instability. They're concerned about inferior returns. They're concerned about, all sorts of things that enter the mix of a decision in a free market. So the government is now basically, they're putting their foot on the scales in terms of allowing people to have a choice about what they're investing in their portfolios, basically. And again, we won't see the impact of this immediately. It's going to take years for us to understand the consequences of the direction of travel. The other positive in that, though, is that we won't necessarily, if it achieves the objectives that the government is looking for, it means that we won't necessarily have to have higher taxes. It means that we won't necessarily face cuts to services. At the end of that pathway, the government's balance sheet looks much better. It looks much healthier. We are in a much better position for the future. And that is potentially also not a bad thing.
But this lasted 25 years, the historical example you used post-war, right? 45 until, the early 70s? So 25, 30 years. So are we looking at a similar time horizon here to see the benefit of this? And how long? And I suppose that all depends on...
It depends on things like...
the political commitment to it for whoever's next in office and things like that. There's all sorts of variables, right?
It depends on, all sorts of variables such as what level inflation sits at. Inflation might really come down. If inflation really comes down, then the impact, of that kind of devaluing of assets is really negated. But at the moment, inflation is up nearer 4% than it is 2%. So, if investors are getting a return below that, then the impact is working. But yeah, you're right. This takes a long time to really feed, through the system. And it is a long-term process kind of thing, but it means in the shorter term that the government has a bit less pressure and is able to perhaps meet some of its fiscal rules.
So I have two things on this. One is we've sat here, you and I, and talked about, look, kicking cans down the road. Like politicians in the past haven't dealt with long-term issues. They found short-term fixes, sticking plaster stuff, and rolled on and rolled on and rolled on. And the scale of these problems has just quantified exponentially as we've carried on and become bigger and bigger issues as we've gone. So on some level, I'm sort of thinking, well, there's some long-term thought in this, which it remains to be seen whether it works or not, but at least someone is thinking in that regard. That's the first thing. The second thing is, we're all on Mouthy Money about helping people to, build, sustain their wealth and protect it. What should we do? Is there anything we can do? I mean, should we be saving more into our SIPs? Should we be mindful of these default funds and try and make bigger decisions now? And I know we don't give advice here, but what's the sort of general options that might be on the table for people who are concerned about this? What should we be going to look out for? What should we be considering when we're doing our financial reviews, that kind of thing?
Yeah. I mean, I think it's very important to just be aware of what your pension pot is doing as a starting point. And so many people aren't.
Find the login, everybody. I hear that so many times, by the way, with conversations. I don't even know the login. Find the login,
don't even
please,
know
everybody.
the login.
Yeah, I know we say set and forget, but this might be one where it's time to set and have a look.
The very first thing you should do before making decisions about what you invest in and all this kind of stuff is just know what's inside your pension as a starting point. That is the key thing. If you're older and you do hold things like, UK gilts in your portfolio, I think it is worth having a conversation with your advisor about it. If you have an advisor, it's worth thinking about it, especially if you've got above a certain income level or, certain portfolio size. Advisors, I think, and I'm not speaking for them here, but I think everybody would be urging caution at this point because, as I say, this is not something that's boom happening today. It's not like a budget where they put up stamp duty or something like that and it's overnight an impact. This is a long-term effect. So whether there is a conversation to be had about repositioning a portfolio in order to ensure that it minimizes the issue, I think is important. And again, a lot of this comes back down to what the government ultimately decides to do through this process. Again, we are only at a kind of a starting point here. So for now, I'd say people need to just be aware of it. People need to understand the potential pitfalls of, inflation eroding the value of your, hard won, over many years, your retirement savings. I will also say that the state pension, I mean, I think there's basically no suggestion, not even reform, I don't think are interested in doing anything about things like the triple lock and that kind of stuff.
Only you're mad enough to suggest it, is that what you're saying?
There's a lot of people talking about it. I think it's so unpopular that will be preserved despite all of this. So I can see a time where the state pension becomes an even more key part of many people's retirement incomes, especially at the lower level, because that is the only thing that is going to be protected against these inflation.
Yeah. Because those inflation guarantees are baked in, right? So
that triple lock just becomes more and more valuable as time goes on, basically. So I think, that is potentially going to be an interesting part of the mix going forward. Whether that creates more unaffordability problems for the government, only time will tell. Again, these are long-term processes, so we will see, really.
Interesting times. And one thing it's worth saying is this isn't a subject that isn't going away, and you're going to keep talking about it, aren't you, on Mouthy Money? So if people do want to follow this, then keep an eye on what we're up to here.
We want to keep abreast of, what the government is doing, what it's changing about pensions and why that matters to people. I know a lot of people kind of glaze over when even just thinking about your pension. But I think now more than ever, we're in a time when you need to think about it. You need to have it in your mind. What is it doing? It's such an important part of people's future retirements or current retirements that you can't afford not to pay attention.
Amen.
I think that's it. Thank you, Chris, first of all, for giving me...
Thank you, Ed, for outlining it in such a clear way.
Keeping
an eye on it.
And thank you everybody for listening. I appreciate this is a very, this is quite a deep, this is like a deep cut subject. It's one that we're very interested in and we think is really important though. So with that, I guess we're done. We'll see you all again very soon. So thank you, Chris.
You're welcome, Ed. Thank you.
And thank you everybody for listening. We'll see you soon. Goodbye. Thank you for tuning into the Mouthy Money podcast. Don't forget to hit like and subscribe on all our content. Follow us for more on your preferred podcasting channel, including Spotify, YouTube, or Apple Podcasts. Stay in touch by following our social channels on Instagram, TikTok, and LinkedIn. And don't forget to subscribe to the Mouthy Money newsletter on mouthymoney.co.uk. The Mouthy Money podcast is produced for general informational purposes only. It should not be construed as investment, legal, tax, or other forms of financial advice. If in any doubt about the themes expressed, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up, and you may get back less than you started with. Never invest more than you can afford to lose. For more information, visit fca.org.uk/invest smart for more. Thank you.